Do you have some hard-earned cash to invest? Looking for some amazing investment opportunities for the coming year? Want to know my top 5 stocks for 2021? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Every day of every year is a great opportunity to increase your wealth and passive income. But the start of a new year is a particularly good time to look at investment ideas that could hold the potential to deliver better results than other investment ideas available. With this in mind, I'm going to reveal my top 5 stock ideas for 2021. Let's say that you have $5,000 that you want to spread across 5 different stocks. Well, you might want to take a good look at this list. Now keep in mind that I'm a long-term investor and these are long-term investment ideas. I think all 5 of these stocks will do very well over the next 10 plus years. And when I think about investing in these businesses, that's the kind of time horizon that I have in mind. However, I think each stock is especially attractive at this point in time due to a variety of reasons that apply to each specific business, such as growth, valuation, yield, fundamentals, and competitive advantages. As a result, I think they'll do well both over the short term and long term. That's a win-win. I've personally invested in stocks just like these on my way to going from below broke at age 27 to financially free at 33, so I know they work. If your aim is to grow your wealth and passive income, become financially independent, and potentially even retire early in life, these stocks could help you do all of that. While this video will reveal the 5 stocks and go over some quick highlights on each one, make sure to check the description box below for a link to a 4,500 word report that does a deep dive into all of these businesses. Let's dig in. Before the big reveal, I want to tell you 3 important things about these 5 stocks. First, they're all dividend growth stocks. Dividend growth stocks tend to outperform the broader market over the long run. It's easy to understand why. Dividends aren't simply a component of the market's total return over the long term. Dividends are the main component, and reinvesting growing dividends intensifies that effect. Second, they're all high quality businesses. Every business I'm going to discuss has excellent fundamentals and durable competitive advantages. It's one thing to be a dividend growth stock. It's quite another thing to be a wonderful business. A growing dividend can, and often does, serve as a great initial litmus test for business quality. That's because only a strong business that's producing growing profit can sustain a growing cash dividend for years on end. But it definitely isn't the only thing to look for. To that point, every business listed has brisk top line and bottom line growth, robust profitability, a rock-solid balance sheet, impressive dividend growth metrics, and numerous competitive advantages. The importance of business quality has never been more clear than right now. 2020 has seen an acceleration of trends worldwide, and businesses that aren't healthy and nimble are getting left behind. Third, they all appear to be attractively valued. Even the best stock in the world can be a poor investment, especially over a shorter period of time, if an investor pays far too much. But if one is able to invest in a great business at a great value, they're setting themselves up for truly outstanding investment performance. That outstanding investment performance is possible over the short term, but it's almost certain over the long term. Now, my top 5 stocks for 2021. Stock number 1 is Johnson & Johnson, stock ticker JNJ. Johnson & Johnson is a global healthcare conglomerate that produces and markets a wide variety of medical devices, pharmaceuticals, and consumer goods. Founded in 1886, this is a $402 billion by market cap healthcare behemoth that employs more than 132,000 people worldwide. When I think of blue chip stocks, this is one of the first stocks that comes to mind. No matter what part of the company's fundamentals you look at, you will find a high amount of quality. It's the kind of stock that can be a cornerstone of a portfolio. Meanwhile, the business is poised to take advantage of a global demographic megatrend. With the global population expanding, the world is getting bigger. And with people living longer than ever, the world is getting older. Then you have the fact that people are, on average, becoming wealthier. When you have a larger pool of older people, you naturally have an increase in demand for quality healthcare products and services. And since these people are getting also richer, their access to these same products and services also increases. That bodes well for Johnson & Johnson and its ability to continue increasing its profit and dividends. The company has already increased its dividend for an incredible 58 consecutive years. That's one of the longest such track records in existence. And with a 10-year dividend growth rate of 6.9% coming on top of a yield of 2.6%, there's an appealing combination of income and growth here. Plus, this is a safe dividend. The payout ratio is 63.5%. In fact, Johnson & Johnson announced a 6% plus dividend increase in April 2020, when the pandemic was fresh and confusion was abound. That speaks volumes about the reliability of the dividend. Johnson & Johnson's revenue is compounded at an annual rate of 3.24% over the last decade. Earnings per share has increased at a compound annual rate of 6.85% over the last 10 years. This stock doesn't knock your socks off with growth. It's instead a consistent performer that steadily increases its profit over time. It just grinds higher and higher while you sleep well at night. They're one of only 2 companies in the world with a AAA credit rating from Standard & Poor's. Then there's the robust profitability. Over the last 5 years, the firm has averaged annual net margin of 16.86% and annual return on equity of 19.53%. They have unmatched scale, with around 70% of sales coming from a number 1 or number 2 global market share position. And their R&D, IP, and brand power further help to protect the business. There's also the fact that Johnson & Johnson is working on a COVID-19 vaccine. I wouldn't buy the stock based on this, but it is something looming in the background that could give the stock a boost in early 2021. The PE ratio is right about 24. At first glance, that actually looks high, but it's based on GAAP earnings, which have been skewed of late. I don't think the stock is a steal at current prices. In fact, I think it's fairly priced, but you don't need a crazy deal on this kind of quality. It's setting investors up for a 10% annual return over the course of 2021, even without being super cheap. That's based purely on the yield and underlying business growth. In this kind of environment, I think a setup for that kind of return on this kind of quality is very nice. This is an extremely compelling long-term investment for 2021 and beyond. Stock number 2 is Lockheed Martin Corporation, stock ticker LMT. Lockheed Martin Corporation is the world's largest defense contractor. Founded in 1912, Lockheed Martin is now a $106 billion by market cap global giant that employs more than 100,000 people. The investment thesis here is so straightforward. Lockheed Martin is the world's largest defense contractor, and it's headquartered in the world's largest consumer, the United States, of defense products and services. It's a money machine. The company has increased its dividend for 18 consecutive years. The stock yields 3%, which is quite the yield when you pair it with a 10-year dividend growth rate of 14.4%. The company actually handed out a double-digit raise back in September, which should give investors a lot of confidence about the state of the business and dividend. Even more confidence should come about after seeing the payout ratio of just 44.8%. This dividend isn't going anywhere but up. Lockheed Martin has compounded its revenue at an annual rate of 3.01% and earnings per share at an annual rate of 12.17% over the last decade. Bolstering the company's already fantastic prospects is the $4.4 billion acquisition of Aerojet Rocketdyne Holdings. Announced in late December, this deal scoops up a supplier and expands Lockheed Martin's space and rocket capabilities. The company's balance sheet is fairly solid, and this bolt-on acquisition doesn't change the financial position meaningfully. While the long-term debt-to-equity ratio of 3.65 looks high, that's due to low common equity from buybacks. The interest coverage ratio of over 12 indicates no issues with its debt costs. Profitability is good, and there's been a clear margin expansion in recent years. Over the last 5 years, the firm has averaged annual net margin of 8.55%. Return on equity, however, is not applicable because of low common equity. This is a technology company disguised as an industrial, yet it's valued less than slower growing consumer companies. And durable competitive advantages like global scale, massive barriers to entry, long-term contracts, technological know-how, and high switching costs, Lockheed Martin does protect the business. With a price-to-earnings ratio of 15, I'd argue the stock is downright cheap. Our special report shows that this stock could be worth $500 a share. Based on the upside, yield, and growth, investors could be looking at a 46% total return in 2021 on this stock. This is one of my very best ideas for dividend growth investors right now. Stock number 3 is WP Carey Inc., stock ticker WPC. WP Carey Inc. is a net lease real estate investment trust. Founded in 1973, WP Carey is a $12 billion by market cap real estate giant that operates globally. The company's worldwide real estate portfolio of over 1,200 properties are spread out across 25 countries and leased out to over 350 tenants in aggregate. One might think real estate is a no-go with the pandemic still not behind us as 2021 begins. Well, let's consider that W.P. Carey has been almost completely unaffected by everything going on. While REITs with heavy exposure to areas like hospitality and leisure have been hurt, W.P. Carey's largest amount of exposure in the real estate portfolio is to industrial properties. Their third quarter fiscal year 2020 report showed a 98.9% portfolio occupancy rate and a 98% overall rent collection. This is not a distressed operation. Compare that rent collection to one of the bluest blue chip of all REITs in Realty Income Corp. Realty Income reported only 93.3% rent collected for October 2020. Yet that stock sports a higher valuation and offers lower yield. They've increased their dividend for 23 consecutive years. They're only 2 years away from becoming a dividend aristocrat. Now, the 5-year dividend growth rate of 2.7% isn't massive. However, this is a stock that yields 6% here. So that kind of growth, especially in an environment with little inflation, is more than enough to get the job done. Based on the midpoint of 2020 adjusted funds from operations per share guidance, the payout ratio is 89%. That's a touch high, but it's not totally out of line for a REIT. W.P. Carey's revenue has a compound annual growth rate of 21.48% over the last decade, while adjusted funds from operations per share has compounded at an annual rate of 4.83% over that period. The balance sheet is strong. Total liabilities of $7.1 billion stack up well against $14 billion in total assets. They ended fiscal year 2019 with a ratio of net debt to adjusted EBITDA of 5.4. Their biggest competitive advantage is scale, but their portfolio makeup is also an advantage in my view, which is showing up in the results. Best of all, the stock looks like a good deal right now. The price to AFFO ratio using the midpoint of fiscal year 2020 adjusted funds from operations per share is 15. This ratio is analogous to a price to earnings ratio for regular stocks. The stock is commanding an undemanding valuation. I think the stock is worth almost $78 a share, as I share in our lengthy special report. While the upside between the current price and what I think the stock is worth, and then you add that with the big yield and underlying business growth, investors could be looking at a total return of 19% over the course of 2021. Much of that would come via that sizable dividend, which is perfect for income-oriented investors. This is a REIT that has held up remarkably well in the face of huge challenges. The stock hasn't been rewarded fully yet, but that could change soon, and investors might want to pick up the stock before that change happens. Stock number 4 is Pinnacle West Capital Corporation, stock ticker PNW. Pinnacle West Capital Corporation is a utility holding company that principally serves as the parent of Arizona Public Service, Arizona's largest and longest serving electric utility. With corporate roots dating back to over 125 years ago, Pinnacle West is now a $8 billion by market cap company that serves 1.2 million customers. Utilities are often a favorite for dividend growth investors. That's because these stocks usually have higher yields backed by a service that people quite literally cannot live without, which is electricity in this case. Utilities have been almost totally unscathed by the pandemic. That predictable cash flow is perfect for income-oriented investors who like to sleep well at night. They've increased their dividend for 9 consecutive years. The 5-year dividend growth rate of 5.4% is paired with a yield of 4.3%. It's worth noting that the company increased its dividend by over 6% in late October. I think that's an awfully nice combination of yield and growth, and the dividend has a well-covered payout ratio of 59.2%. This is a reliable dividend that investors can count on. The company has grown its top line at a compound annual rate of 0.69% over the last decade, while the bottom line has compounded at an annual rate of 4.28% over that same period. The dividend is growing slightly faster than earnings, so I'd expect that to be reconciled at some point. However, the strong growth that Arizona is seeing right now will help to correct this disparity. Their balance sheet is another area of strength. The long-term debt-to-equity ratio is 0.89, while the interest coverage ratio is a bit under 4. Profitability is strong and margins are impressive. Over the last 5 years, the firm has averaged annual net margin of 13.64% and annual return on equity of 9.85%. The big competitive advantage that a utility like Pinnacle West Capital has is the geographic monopoly. There's typically only one electric provider in any one service area, and a unique regulatory structure practically guarantees profit. The stock offers a lot to like, and the valuation only serves to reinforce that. The stock is trading hands for a price-to-earnings ratio of just under 14 right now. Our special report shows how I arrived at a fair value of just over $90 per share for this stock. If we account for the valuation upside, the yield, and the underlying growth, that adds up to a potential 25% total return for 2021. In the land of high-quality utility stocks, Pinnacle West Capital stands out as one of the best long-term investment opportunities for dividend growth investors. Stock number 5 is Aflac Inc., stock ticker AFL. Aflac Inc. is an insurance company that primarily primarily sells supplemental insurance products to clients in the United States and Japan. Founded in 1955, Aflac has grown into a very successful niche insurance business that employs almost 12,000 people. This is yet another case where there's a disconnect. The business has held up well throughout the pandemic, yet the stock has not. The stock is down almost 19% year to date. That's stock performance. Now let's contrast that with business performance. The company reported third quarter fiscal year 2020 results on October 27th, showing $5.7 billion in revenue. That's above the $5.5 billion in revenue they produced in the third quarter of fiscal year 2019. Meantime, diluted GAAP earnings per share increased 231% year over year. There are some currency, tax, and investment fluctuations that can cause volatile GAAP earnings for Aflac, but the company is growing at a good clip. Aflac's business is doing well, yet the stock is not, and that's a big part of why I'm presenting this idea to you. I can tell you something else that's doing well: Aflac's dividend. The company increased its dividend by almost 18% in mid-November. That's one of the largest dividend increases I've seen in 2020, and it marks 39 consecutive years of dividend raises for Aflac. The 10-year dividend growth rate is 6.8%, which is paired with a 3.1% yield. Investors should sleep well at night knowing this is one of the safest dividends out there with a very low payout ratio of 20.7%. These are some of the most impressive dividend metrics I'm aware of. It's a dividend growth star, and that track record has been built on the back of a fine business. Revenue is compounded at an annual rate of 0.77% over the last decade, but earnings per share has grown at a compound annual rate of 6.75% over that time frame. A 21% reduction in the outstanding share count definitely helped to propel some excess bottom line growth. Their balance sheet is outstanding. The long-term debt to equity ratio is 0.22 and the interest coverage ratio is over 20. Profitability is robust. Over the last 5 years, they've averaged annual net margin of 15.18% and annual return on equity of 14.34%. Their scale and sales force gives them unique competitive advantages within their niche. You'd think this stock would be expensive, but it's not. It's trading hands for a price to earnings ratio of below 7. On the face of it, that's ludicrously low. As noted earlier, GAAP earnings per share can be volatile for this stock, but every basic valuation metric indicates an extreme amount of cheapness. I think the stock is worth $47.50 per share, as I lay out in our special report. Based on valuation upside, underlying growth, and the 3% yield, investors could be looking at a 20.5% total return on this stock over the course of 2021. This is priced like a no-growth, high-risk stock, but none of that shows up in the actual business results. Because of the wide disconnect between business and stock performance, Aflac is one of my top ideas for 2021 and many years to come. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these stocks. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.